My name is Cammy Corso. I am a principal with DHJJ Financial Advisors, and we wanted to welcome you today for our webinar on retirement on the horizon. Emily Verdone is one of my colleagues, and we're going to be speaking today about a variety of topics that you'll want to consider as you approach retirement. So, here at DHJJ Financial Advisors, we do a lot of planning for our clients. So, what is retirement planning? Obviously, on our side, it's running quite a few plans and running the numbers to see what the numbers look like. But how do you even do that? It starts with talking and having that discussion about what do you want your retirement to look like? It's really about your personalized goals. This is sometimes the hardest part when you think about retirement. What do you envision? So, this is going to be different for everyone. It's really thinking through what do you want to do when you're done with work? What does a happy, healthy retirement look like for you? How do you want to spend your time? What stress are you looking to alleviate? How can you accomplish that? What risks are you looking to minimize? And then really figuring out how can you accomplish that? So maybe you're 5 years away from retirement, 10 years. It's really never too early to start retirement planning, but we have a lot of clients who come to us a couple years out because there's definitely some opportunity to do some planning in those last few years before you retire to position yourself, typically save on the tax side as well if you have the time to do that. So really an individualized process, but the things you're going to walk through are things everyone can really do as part of their plan. It's just you'll all have different goals. I am going to turn it over to Emily to go ahead and cover our first section, which is cash flow planning.
So as Cammy mentioned, the cash flow planning is very individualized. A lot of it starts with asking yourself some questions. And these are things that if we were doing a cash flow plan with you, we would go through with you, but it's things you may want to think about even before you would meet with a financial advisor. Things like, what is your current lifestyle? And how does that translate to how you want your lifestyle to be in retirement? Do you want to travel more? Do you plan to spend more time with your grandkids? Those are the types of things that could add expenses in the years of retirement. Also, how comfortable are you with the market? Are you taking on the right amount of risk? With how comfortable you are with the market, where should you be invested? What types of accounts should you be contributing to maximize your retirement income after tax? Also, to think about what's the current tax rate versus future tax rate. Right now, we're in years of low tax rates. The taxes are set to sunset in 2026, and tax rates will be going up at that point. Where will you draw your assets from? And can you do anything different than what you're doing now in order to make your plans more successful in the future? So the goal is really to get you the best after tax returns without increasing your risk above where you're comfortable. In order to take a look at what your cash flow plan is, we really need to start with is your personal balance sheet. So what assets do you have? Mortgages, loans, anything you have outstanding, and deciding what your goals are. So as I mentioned before, maybe you want to retire early, travel. Do you have kids you're trying to put through college, or maybe grandkids? Do you want to leave a legacy to your kids or charity? Those are the types of things you'll want to think about in order to figure out what we need to make changes now so that we get you to where you want to be. So what we do from there is we take an estimate of what you're earning currently and what you think you'll be earning the remainder of your working years, whether or not you want to semi-retire maybe at 60 and still work to your 65. We can kind of change our assumptions to show decreased income. One of the biggest drivers outside of income is really what your expenses are. So you have to kind of do some analysis, think about how you're spending your money now and how you think that might change later. Another big issue we see in retirement is just the cost of healthcare expenses. So figuring out your medical history, do you think you're going to have more expenses? Do we need to look at long-term care insurance? Those types of questions. And then basically plan for the worst case scenario and see where we end up. And as part of this, what we'll do is look at where you are invested, where your money is, how we expect that to grow through the remainder of your years to retirement, and then figure out how we should pull those assets out so that you maximize the value you have in your accounts. A couple different buckets, Cammy will get into this, might be using Roth versus your IRA income, using a mix of assets in order to get the best value out of your accounts. Since we are connected to a CPA firm, Cammy and I are both CPAs, we do look at this a lot from a tax perspective as well, and just see how tax rates will drive the analysis and where you should pull from. Along with that, a big question that a lot of retirees have is, when should I collect Social Security? With a financial plan, we can analyze some of the break-even points and figure out the best strategy for your personal situation. So there's really 3 different times to collect. You can either collect early for a decreased benefit, you can collect at full retirement age, which that age depends on what year you were born. And then you can also defer past full retirement age and collect an increased amount. So your benefits change depending on when you start collecting. And there's also an option for spousal benefits. So if your benefits are less than 50% of your spouse's, you can collect on your spouse's benefits as well, which might increase your overall Social Security. So when we run these plans, there will be a breakdown that the software spits out, which will kind of analyze when you should pull out. It's a personal decision. A lot of it has to do with medical history and what you think your expected life expectancy is. You can make a little bit more of an informed decision. We would provide you with this breakdown, and it kind of leaves the decision up to you, but gives you a little bit clearer picture of when you should collect.
So we did get a question about Medicare and if that's something we can help with here at our firm. We are not insurance brokers. We do not sell anything. However, we do know, different brokers, and a service we found to be very helpful for Medicare is called SHIP, or Senior Health Insurance Program. It's up on the slide here. And that is free, and they host seminars that you can actually go to. And we've had clients use this service. I know they conduct them in downtown Naperville, but you can go to this website and see where they're offered, but they will touch on everything Medicare. So if you're at the point where you're wondering, well, what happens when I go off my company insurance? And I get to 65, what then? This is a great resource. Again, it's free and it's just a ton of information. So as you make that switch from your current insurance, whether it's PPO or whatever you have, and you switch on to Medicare, you'll know what your options are there, as well as, you can be put in touch through them with people who do sell the supplemental policies. So this has been a great benefit, and it's free. So what we can do on our side is look at the cost of insurance and work that into these cash flow plans. So when we run out the numbers, what we'll do on our side, or any financial advisor will do, is they can make reasonable assumptions about what certain types of policies will cost. So that we can absolutely do, but we do not, do any sort of running. We don't have access. We're not brokers or anything like that. So we strongly advise, you check this out. And again, ton of information. Our clients that have used it have been really happy. They found it very helpful. Emily talked about running your cash flow plan. And that's what a lot of people think about when they think about, retirement planning, is, do I have enough, right? That's typically the greatest fear, is, am I going to outlive my assets? So when you're doing your cash flow planning, you start with what you've saved. There's different variables you're going to have to work into your plan to put, reasonable assumptions to where your assets are either going to grow to, or how much you'll have at the various ages, to see, what your financial future looks like. And a big component of that would be, what is your investment strategy? Because when you build out a cash flow plan, you have to be able to put a reasonable rate of return on what you're investing to get to the outcome of your projections. So, this is a great quote, and it speaks to just the emotions of the market, right? I mean, not that we'll all get rich, but really, when things feel good, that's actually the right time to be a little bit fearful. And when things feel terrible long term, that's probably the right time to, be greedy, in Warren Buffett's words. But that just means, sentiment is a big part of investing. We have to be able to understand how we feel and how that's driving our investment decisions. Because at the end of the day, we really don't want it to. We want to be aware of how we're going to feel and how we react, but we really don't want our, emotions to dictate how we invest. But the right time to put money in is when it feels terrible, and the worst time to, sell is when it feels terrible. So it's a true statement by Buffett. So when you do your cash flow plan, that's how you, I mean, it's really helpful to start there. Start with what do the numbers look like when you run them out. With that, you can look at different rates of return on your numbers, on your cash flow to say, okay, I'm running these, let's say, 5%. How does that look? And from there, you can decide, is a 5% rate of return enough? Does that get you to where you want to go? Once you run the numbers and you see how much risk you need or what rates of return you need to meet your goals, then you can decide how much you want. A lot of clients will run these and they'll say, you know, that looks good. The numbers look, good to me. Maybe I don't want that much risk. Or, they'll say, well, I can actually take on more risk based on this. So the numbers, running them out is a huge step in how you should be investing your money. Also, knowing yourself, what kind of investor are you? You want to understand why you're doing the things you're doing and the way you're investing. What is your strategy? Why are you invested that way? It'll give you the ability to stay invested. But if you know what your past behavior's been, that's a pretty good indicator of what you'll do in the future too with the markets. So just some things to ask yourself, when things get tough, what do you do? Do you have somebody to talk to when things get tough? And then just the saying, save like a pessimist, invest like an optimist. If it can do that, it's not easy, but that's the way to go. So one thing you can do and is very helpful is to actually run a risk assessment. There are great tools out there that will help you assess how comfortable you are with risk. We use this software called Riskalyze, and what it does is it puts into numbers. It'll give you that number up there is a risk score based on a questionnaire. And then what it'll do, it'll say, you answer the questions these way. Here's your risk tolerance. And it'll go another step and it'll say, okay, if that's your risk tolerance, we'll go ahead and simulate a portfolio with that risk to show you what would have happened during, some previous market cycles. So it'll go through a bear market, it'll go through a bull market, and it'll actually put into numbers. Up on the right hand side, you'll get your risk score, but you'll also get these numbers to put it right in front of you of what that means on the upside downside risk for your portfolio. So sometimes the numbers can be very telling. Sometimes we think, you know, we want a lot of risk, and then we actually see the upside downside potential and we decide maybe a little bit less, or vice versa. So it's extremely helpful to use the technology that's out there today to actually put things kind of in front of your face and into numerics as you're going into the market or deciding what your strategy is going to be going forward. Okay, so some common mistakes, just be careful. Lack of diversification. Sometimes people take on too much risk. Sometimes it's too little risk where they can't meet their needs because they're being too conservative. Oftentimes it's that the risk and the time horizon don't align. And that just means, maybe you stayed too risky too long, or maybe you were too conservative too long. But the big thing is, you don't want any short-term cash flow needs invested in the market, right? And so knowing what that plan is as you're approaching retirement, what are your cash flow needs going to be? And is your risk tolerance appropriate? If you need to make that shift, how do you make that shift? When do you make that shift to get to the appropriate risk tolerance to align with your time horizon going forward? Okay. So just another quote, the market has cycles. I think we all know this, but you get recessions, you have stock market declines. If you don't understand that's going to happen, you're not ready, you won't do well in the market. So this is Peter Lynch, who ran the Magellan Fund for Fidelity for a long time. It's just, you do have to be able to stomach the cycles, right? So depending on how you're currently invested, sometimes our risk tolerance will change as we approach retirement because we're no longer accumulating assets. So again, it's that behavioral side. How are you going to feel? Um, you just don't want to be invested in a way that makes you uncomfortable, where we hit a tough market like the one we're in now, a bear market, and you want to sell at lows, right? So just being very focused on risk as you approach retirement is important. So yeah, equities go through cycles. It's important to understand too that fixed income goes through cycles. I'll bring up some charts here in a minute. But equities, knowing the risks in the equity market, there are different risks in different sectors. And then even on the fixed income side, which is our bond market, we have credit risk, we have interest rate risk, which we've seen this year. Credit risk, you're going to see more in a recession. There's liquidity risk, which can, really hit certain funds that are potentially smaller. Like basically know what you're invested in is the takeaway here. But there are always risks to assess, and understanding what risks are out there based on current market situations is important. But this cycle has been particularly hard because there's been a correlation, right? Equities are down as well as fixed income, which is not typical. So this is just a chart, and hopefully you can see it. If you're on a computer, you should be able to see it. This pink line is the S&P, and this goes back to 2019. So we can see what happened March of 2020, everything was down. And you can see fixed income stayed relatively stable, right? This purple line is our aggregate US, the bond index. So typically when the equity markets are down, bonds will hold up. They'll kind of be a ballast to the portfolio. They'll keep it, that part of the portfolio pretty stable. But you can see here what we're doing in 2022. Equity markets have had a tough year, and the bond markets have had just as tough of a year. So there's been correlation, which can be hard when you're trying to, go into retirement and need to cash flow a portfolio. So just to quickly touch on, what's going on with fixed income and why you need to be aware of risks there. You can see this blue line here. This is what's happened with rate hikes this cycle. And you can even add another one onto here because the Fed just hiked rates another 75 basis points. So what's happening this year is not typical, right? If we look at the aggregate bond index, and again, this is a courtesy of Charles Schwab, the aggregate bond index over here is where we're at so far this year. This is an outlier as far as fixed income. So, when the ag's down 13, 14% for the year, and that's supposed to be the more stable part of your portfolio, yes, equities are down more, but it just speaks, really just knowing where your cash flow is going to come from, because, markets they go through cycles and they're not all predictable. Okay, so when you're looking at investment management, how to invest money, if we're working with an advisor, what should they be thinking about? Really, short-term cash needs is big, right? Having those set aside with the least amount of risk, because that's where you're going to pull from as you need to take money out of your portfolio to live on. And then positioning those long-term cash needs for future growth with the right risk tolerance. Another thing to consider with how you invest, what you're investing in, is tax efficiency. So Emily touched on this. We are CPAs as well as CFPs, so everything we do is with a bit of a tax lens on it. So thinking about, you know, where should your equities be held? Where should your fixed income be held? And why? That is a tax strategy to investing. Um, Also, what type of investment, right? Do you want to be in mutual funds? Do you want to be in exchange traded funds? They are a bit different on the tax side as far as how income kicks out and has to kick out. ETFs are a bit more tax efficient. So understanding, does that make sense for you over mutual funds? And then, of course, there's other vehicles that are, tax deferred, which would be annuities, or life insurance could be tax free. So when you think about your different buckets of assets and where do you want to save and what do you want to spend from first, you should be thinking about the three categories. So your taxable account is going to be, if you had a savings and checking and you're building up excess funds there, do you open an investment account and put it to work? That is taxable in that money's already been taxed. Then you have your tax deferred, which is your 401k or 403b, IRA, deferred comp. Anything that when you pull out of it will be considered taxable income to you. And here's the best bucket. If you could get all your money here, it goes a lot further, right? It's tax free. When you put it in, there's no tax benefit. You don't get a tax deduction. But when you take it out and while it's in there, it grows tax free. So definitely the Roth IRA, the Roth 401k, again, to the extent you can get assets to grow in that bucket, that will give you, really net a dollar in plus growth. When it comes out, it's that true value. There is no tax due on it. So again, it's where to save and then how do you invest in each bucket. With taxable accounts, anything you sell in there is going to be, any gains in there are going to be taxable on your income tax return. So being aware of that, maybe you want to put more equities in there because there's a qualified rate on dividends and equities pay out qualified dividends, or could, depending on the equity fund you're in. So it's knowing not just where to save, or not, thinking through which bucket you contribute to and then what investments you hold in which bucket. That can really add to the best after tax returns. Okay, so with that, I will turn it over to Emily to go through some tax planning.
Really, when it comes down to tax planning, it's looking at year over year, what's the tax going to be on the next dollar, the tax savings on the next dollar of deduction. It's really important if you have years where you know income's going to be up already. So if you have a big transaction, a big capital gain, or a big, you own a business, you have a big sale coming through, income's up, that's when you would want to, at the end of the year, look and see, are there any deductions that I can accelerate? Can I contribute to a DAF to pull money, bring deductions in this year, and then spread the actual contributions out over in a normal time frame? So those are things we like to start thinking about once we run these plans, see where your low income years are going to be. We want to take it a step further and say, what can we do to make it better? And where this really comes into play is in those years where you retire from retirement until your RMDs. If you retire at 65, RMDs start at 72. That's 7 years that you have with lower income, where it's a great opportunity to bring Roth conversions to the table. You pay the tax at a lower rate because your taxable income is so low in those years, and then you wouldn't pay the tax later on. As Cammy mentioned, that's a bucket that you really want to have a lot of your assets in retirement because you're not paying for it. So when your RMDs hit, your taxable income goes up, and it's not as beneficial to pull out more from the IRAs at that point. So that's something that you want to look at every year, November, December, once you have a picture of what your year looks like from a tax and income tax perspective. That's when you'd want to do a little bit more of that in-depth tax planning, run out some projections, see how much Roth you can bring in at a lower tax rate, and figure out what you're comfortable paying this year versus next year. There's also been some changes with the standard deduction. So right now the standard deductions are historically high. A lot of people are losing the benefit for mortgage interest. And that's something you may want to look at. What is your mortgage costing you with the new tax laws? Is it more beneficial to keep it at a low rate and put money in the market? There's different planning we can do with that as well. Just figuring out where you're hitting that standard deduction and then what we can do to change that and make your deductions higher. The other thing that you want to look at with that is the capital gains rate. This is the newest bracket for, I believe this is for 2022. So this is how much money you can bring in depending on what tax rate you're in for income tax. This is where you hit the 0 versus 15 versus 20 for capital gains. So that's where you want to take a look at any unrealized gain in the account and see if you can step up to a better tax basis with no tax impact. It's also times where you want to this is a perfect market to look at tax loss harvesting. So we've been doing that with a lot of our clients where we look and intentionally take losses, go into a similar fund, and we have those losses we can take on their tax return. So that way down the road, we can bring more gain in at no tax cost. So the one thing you want to think about with that is your state income taxes, what states are charging with that. And it all depends on the state tax rules. Illinois starts out at federal AGI, so there's no difference in income tax rate for Illinois, but other states have different ways they tax capital gains.
Thanks, Emily. All right. So estate planning. There's a few different pieces to estate planning. You have the legal side, which would be drafting your documents, getting all the actual legal things in order. And then there's the planning side. The estate planning can either be to reduce your estate so you don't go up against an estate tax, or it can really just be what are your intentions. So there's the logistics, there's the income, or there's the estate tax, which is actually tax payment above if your estate's over a certain amount. But it starts with really thinking through what do you have today and where would you want to go if something happens to you tomorrow. Who do you want it to go to? That's a big decision. And then making sure all your documents are drafted in accordance with your wishes. But I think one thing we forget to think about is, how do you want those assets to be held? When do you want them to transfer to the beneficiaries? Those are all things you can decide with your estate plan using various legal documents. Thinking through that is definitely not easy. The right time to do it is, if you don't have a plan in place, I would highly recommend getting one because you can always change it, right? As long as you're drafting documents that are not irrevocable, it can always be changed. So estate planning, really, you have your basic documents. What we all hear about is a will, right? You're going to walk through that. The attorney's going to draft it. You do need to have the original will, so keep that somewhere safe. That will be needed for your executor at some point. You don't just want a copy, so keep your will somewhere safe. You'll also want power of attorney forms. That would be a healthcare power of attorney and a financial power of attorney. They can be the same person you name, they can be different people, but definitely get those in place so you know who could, make decisions for you if you're not able to. So that's kind of your basic plan. Any estate planning attorney, those are your three basics. And so beyond that, what are some things you can accomplish? Why do we do estate planning as part of financial and retirement planning? It's really so your assets go to who you want them to go to, when you want them to go there. A lot of people, their goal is to avoid probate. If any of you have been an executor of an estate before, it is not a simple process. So if I die with just a will and I hold things in my individual name, my assets go through probate or the courts. Holding things and having a will, if they're in your individual name, assets will still go through probate. So a will not accomplish avoiding probate. It will go through the legal system. If you're looking to avoid probate, you need to have your assets held jointly, or you need a beneficiary designation on them. If they're held jointly, at least in Illinois, you hold something jointly like a bank account. I die, it goes to the joint owner. Or you can name a transfer on death or a payable on death designation on your accounts. That is for taxable accounts. If you have qualified assets like an IRA or a Roth IRA, you're going to need to have a beneficiary designation. If you're going to do, your financial planning, retirement planning checklist, review those beneficiary designations. Whatever is on there that is how the assets will be distributed. So even if you update your will and change where you want your assets to go, if you have not changed your beneficiary designation on a life insurance policy or an IRA, it's going to go to whoever's named on those assets. So just make sure your beneficiaries are up to date. Consider contingent beneficiaries. So maybe you have a spouse, they would be your beneficiary, and maybe you have children. You can name not just your beneficiary, but contingent beneficiaries. So if for some reason, your named beneficiary would pass before you or predecease, you would have a contingent on there for the assets to pass and according to those designations, if you only have a beneficiary designation, something happens to your beneficiary, they're no longer here, they predecease, everything reverts back to basically your estate, flows through the courts, and gets passed out according to your will. Trying to avoid probate, jointly titled assets, transfer on death, beneficiary designations. And this last one here is one we have clients ask about a lot, and that would be a living trust. Clients will ask, do I need a trust? So it just depends on your situation. A trust, if you pass your assets according to your will or these beneficiary designations, so if things are going through joint ownership, transfer on death, or beneficiary designations, these first 3 points, those assets will go outright to those people as soon as you pass. Living wills have the potential to hold assets in a trust when you pass and have assets passed out in the future. So if you're looking to transfer assets when you pass, but maybe not immediately, depending on who the beneficiaries are, how much you're transferring, if you think those beneficiaries are capable of handling those financial affairs, you can create a living trust during your life. It's the same as you. It has your social security number. It doesn't really become its own entity until you die. So during your life, you could title bank accounts in the name of your trust. You can title investment accounts in the name of your trust. And that way, when you pass, those accounts would pass according to your trust document. So this living trust would allow you to dictate who gets assets that are in the name of your living trust when you die and when. It provides of it avoids probate because a trust keeps things private. So when you pass, there is no probate process if your assets are in your living trust. And it also allows you to control your assets more beyond your death. Some people, it's not important to them, and some people, for various reasons, it is. Also, potentially, those trusts that are set up when you pass may provide asset protection for beneficiaries. Yes, it's going to cost you more on the front end, but usually the back end cost of avoiding probate, your beneficiaries would save on the back end. So it's not that complicated to set up. A lot of the times, if you're doing your basic estate plan, you can add on a living trust as well. And while you're alive, you can change it. So if you set it up to say, I want these people to get the assets at this time when I'm no longer here, if you decide you want to change that, you can revise your trust. Once you pass, there are no revisions for that document. Also, some people like that if you pass, now there's your assets, and if somebody needs to handle those affairs and distribute the assets, or let's say it's a significant amount of wealth, maybe you want to name a corporate trustee. So, different banks will serve as trustees or trust companies that will serve as trustees. So, if you don't want to have a family member have to handle that trustee responsibility or distribution of your estate responsibility, that would be another reason to do a living trust, would be to get the help of a corporate trustee to take that either burden or responsibility away from friends or family. So again, living trust, it's you during your life. It only becomes its own taxpayer and standalone entity once you die. And it gives you a lot more control in distributing assets than a will would. So insurance planning. We do not sell any insurance here. We don't sell any products. But what we do with our cash flow planning and when we do retirement planning is we look at risks, right? Why do we have insurance? It's typically, depending on the type, it's to reduce risk if something were to happen to us, right? While you're younger in your working years, you typically have life insurance, like a term product for income replacement. So it's looking at what insurance do you have in place right now? Do you still need it? Sometimes what you bought may not be what you still need. So again, term insurance, you can use that usually for, you want to run the plans, you want to run out the numbers to see how much you need, but typically rule of thumb, you're going to be 5 to 10 years of income replacement is a typical term product. A permanent product in the life insurance space, that is going to be more for if you're saving money and you want to retain cash value in your insurance, a whole life insurance policy will retain cash value. So yes, your premiums will be higher, but you're essentially putting money away into a vehicle that would provide life insurance if you were to pass. In the meantime, if you needed to borrow on it, there is that functionality with permanent products typically to tap into the cash value that's accumulating. So you see a lot of people do this when they want potentially access to that cash value. And they don't want to give it all up, but they also want life insurance. They're more expensive, so it has to make sense. A lot of the times we'll see people who have them and no longer need them. What you want to do is just get a in-force illustration of what products you currently have and still see if it fits in with your plan. Some of these permanent products can get expensive as you age, and so it's understanding what's going to happen in the future to say if you do have cash value in a product, is that still the best place to have that cash, or should you convert it or potentially buy a different type of product? There are overfunded life insurance products which will build up cash value that, there's typically some marketplace, some market index links in there where you're essentially combining an investment vehicle and a life insurance vehicle and putting a lot of premiums into that for a set period of time. The overfunded products, the attractive part of those can be that you can borrow on them in retirement, potentially tax free. It has to be within parameters and testing, but sometimes you can overfund life insurance, have a nice death benefit if you were to, have an early death. But if you don't, you can use that cash value you're funding. It's essentially tax free distributions in retirement. So, again, what do you have right now? Do you still need it? Also, is there anything missing? Do you have long term care? I think Emily hit on this, and it is probably one of the biggest risks, and we like to simulate it in all of our different retirement planning and all financial planning scenarios. If you don't have long-term care and if you would need that care, what would it cost you? We know the typical cost. The average stay is about 2.5 years right now. If somebody goes into long-term care, that average stay is about 2.5 years. It's about 7 to 8 thousand a month around here for a lot of facilities if you're at that higher level of care. So usually you can simulate it in that plan, in your financial plan, your retirement plan, and you basically say, if I don't have long-term care, am I going to be okay to self-fund or or not? And then you can decide if you want to get the insurance. So again, looking at what you have, is it still the best use of your funds? That's the way to think about it. How does it fit into your plan? And are there any risks? If you don't have the long term care insurance, are you leaving a risk out there that's unnecessary if you could use some of your assets to fund this type of insurance? Most long term care products right now are not in this standalone arena anymore. Almost all of them that we see are in this life insurance product with a long term care rider. And that basically means you get a life insurance policy and you get a long term care rider, which would accelerate the death benefit should you need it for long term care. And again, there's going to be parameters around that, how much you can get and when. But really, you see, so when you think about it, you're really buying life insurance and long term care at the same time. If you're still working, if you're going to work for a while still, there's disability insurance. Again, it's an income replacement type insurance. But at the end of the day, it just goes back to understanding what you have. It doesn't mean what you have is bad. It may have filled a need in the past that you no longer have, or it may be the right thing to have going forward. There are some products out there that you would not want to get rid of because they don't exist anymore and you're lucky you have it. So it's just going through that exercise of getting the review and saying, what do I want to keep and where do I want to spend my money going forward? We will go ahead and bring up our disclosure slide. I will go ahead, and we do have a few questions here. Emily, maybe you want to take this first one. It says, what are the two most important things to do right now to prepare for retirement?
The two most important things really that you can do for your retirement is first to figure out what your goals are and what you want your retirement to look like, because really gets down into what we need in order to project your success and drive how to get you there. So the first thing is really have those discussions, figure out what you want your life to look like, what your goals are, during your life, after your life, if you want to leave a legacy. And then the second most important thing really is to just run the numbers and do a financial plan to see if you're able to achieve these goals the way you're going now, or if there's anything we need to do to tweak it in order to make you more successful towards your goals. Or if there's things that, as Kimmy kind of mentioned, there you can take on, maybe you can take on less risk than you need. So really running that financial plan in order to see how future is forecasted to look like, and then figure out what steps we can take to ensure that.
This next one I think I can take. It was, how do I retire but still hold on to my business? So that's actually one we look at quite a bit here. Emily and I both work on the CPA firm side as well, and a lot of our clients are business owners and all privately held businesses. So it is a definitely a strategy. We work with clients quite a bit. And how do you save outside of your company so you have the assets you need in retirement? Each situation's different, but typically what we see is, I mean, the goal would be to have an exit strategy, right? So even if you retain ownership, how do you yourself get out of, assuming you're an employee of the company or active in the company and being compensated right now? How do you go from that, where that was where your cash flow is coming from, into retirement? Where are your assets going to come from at that point? So it's looking at, if you're still an owner of the company, you're in the company's cash flowing, probably still going to get distributions. So what is the gap there between what you're able to take out of the company, from as far as distributions or profit? What's the gap? What's the need to fill? So you can do a lot with retirement structures within the company, or just in those last few years before retirement, really doing your best to get wealth outside of your company. A lot of it's going to be dependent on what cash is available to take out, but we've helped a lot of clients look at what retirement vehicles they can set up within their company to fund those. So when they retire and they walk away as an active employee, maybe still an owner, when they walk away from the company as an active employee into retirement, they can access those retirement funds. You can do things like 401ks with, a profit share. You can do cash balance plans potentially. So it's understanding how, your retirement needs fit in with those. It's really the tax planning too, and the cash flow planning of your company currently. So I think it's working with the business CPA and taking that big picture approach in how to get that value out of your company and those assets out of your company so they're there for you to access in retirement. How does the economy play into retiring right now?
Great question. So that is really, you want to think long-term goals. So a good time actually to be contributing to those retirement funds. So I know it's scary and the market's down right now, but it's the perfect time to contribute more assets to those funds. And just, it's a good reminder too, you need to be planning for the risk that you can't see. So if you were to do a cash flow plan, maybe we would run it at a more conservative, take a more conservative approach. So that way we're taking into account some worst case scenarios and having that flexibility within your plan to go more towards those goals and be more successful with your financial plan. Think long term, that's really the takeaway. It's a long term investment. Cammy had a great quote on that: if you can't stomach it, maybe you shouldn't be in the market. So just think long term, even when those statements don't look so great. We had asked if we could repeat the typical cost for long-term care in our area. And
That's typically what we see. So, with the hundreds of clients we have on the financial advisory side, and even just working with all of our tax clients that have nothing to do with financial advisory, you do see a lot, right? The tax return will show those costs. So, yeah, the average cost of a long-term care facility around here, it depends on the level of care. Usually the lowest level of care is going to be about 4,500. Average cost of care, I would say, is between 7 and 8,000 a month. And then if you get all the way up to memory care, that can be, even more expensive than that. And the average stay, as far as what we would build into a plan to simulate, the average stay, if you need long-term care, is about 2.4, we say 2.5 years. So yeah, 7 to 8 grand is the average. That's what we would use in a plan to simulate the cost. But it is variable. I know other states are a little bit cheaper. Yeah.
Yeah. And that's something you'd want to look at too if you want to stay in Illinois or if there's different places you'd like to retire. Maybe those costs would be different as well. And then the other question was just what is a typical range of cost for for complete estate planning?
So it really depends on complexity. So if we don't do documents here, you'd be going to an attorney. I think they usually start probably around 1500 and go up from there. If you're getting a living trust, you're probably looking at closer to 3500 for, the will, the powers of attorney, and a living trust. If you have a spouse, usually there's some benefit where you're not just paying double that because a lot of the times the spouse's documents will mirror one another. But I would say minimum for just the will and the powers of attorney, it's probably about 1500 to 2000. And then with the trust, 3500 and up. It just depends on how complex you want to get and what size law firm you're looking to work with. But those are pretty reasonable estimates for around here. Okay, I think the last one I had, Emily, maybe you can take this one, is how much life insurance do I need to replace my income and specifically in retirement?
That is another very individualized question. So that it goes back to kind of what Cammy was talking about with the different types of insurance that you have. So maybe you do have some whole life that has some cash value, and we take that into account as we look at these financial plans. But really, it is figuring out what income you will have in retirement. So without knowing your projected income in retirement, there's no way to figure out the break even of what insurance you would need. So you would need to project and understand what your income in retirement is and figure out what that cash flow looks like in order to figure out the break even for your insurance. And then it would be a discussion of what type of insurance is best. A lot of our clients that we see, they end up doing that hybrid long-term long-term care insurance. So maybe that's an option versus a straight term product. It all depends on your specific situation for that.
Yeah, absolutely. Yeah, it's what's the best use of your dollars for sure. And sometimes you can combine them to accomplish, a few needs with one product. So we really appreciate your time. If there's anything we can help you with, please, let us know after this, and we'd be happy to do, a one-on-one call to see kind of what you're looking for. So hopefully you found it informative and learned something and can take something away from it. So we will see y'all soon.